the receiver is unable to find a buyer for the institution. The same property must be rolled over. If property is distributed to you from an IRA, and you complete the rollover by contributing property to an IRA, the rollover is tax-free only if the property you contribute is the same property that was distributed to you. Partial rollover. If you withdraw assets from a traditional IRA, you can roll over part of the withdrawal tax-free and keep the rest of it. The amount you keep will generally be taxable unless for the part that is a return of non-deductible contribution. The amount you keep may be subject to 10% additional tax on other distributions discussed later under what acts result in penalties or additional tax. Required distributions. Amounts that must be distributed during a particular year under the required distribution rules discussed later are not eligible for rollover. Inherited IRA. You inherit a traditional IRA from your spouse. You generally can roll it over, or you can choose to make the inherited IRA your own, discussed earlier under what if you inherit an IRA. Not inherited from spouse. If you inherit a traditional IRA from someone other than your spouse, you cannot roll it over to or allow it to receive a rollover contribution. You must withdraw the IRA assets within a certain period. For more information, when must you withdraw assets or required minimum distribution, and discusses this topic. Rollover of required distributions not allowed. If the owner had a required distribution in the year of his or her death, you cannot roll over such distribution. If you do not treat the IRA as your own, you cannot roll over any of the required distributions in years after your deceased spouse's death. Any rollover contributions you make to your own IRA, these required distributions you make to your own IRA, these required distributions are subject to the 6% tax assessed and tax on contributions. For more information on distribution rules after the owner's death to IRA beneficiaries later. Reporting rollovers from the IRAs. Report any rollover from one traditional IRA to the same or another traditional IRA on Form 1040, lines 15A and 15B, Form 1040A, lines 11A and 11B, or Form 1040R, lines 16A and 16B. Under the total amount of the distribution on Form 1040, line 15A, Form 1040A, line 11A, or Form 1040R, line 16A. If the total amount of Form 1040, line 15A, Form 10 blah 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 was rolled over, enter 0 on that line and that line. If the total distribution was not rolled over, enter the taxable portion of the part that was not rolled over from 15B to 11B or 16B. Put rollover next to line 15B, line 11B, or line 16B, and see your tax return. Any I'm going to continue reading about IRAs in IRS publication 590, and I'm on page 26, talking about if you rolled over the distribution from a qualified plan other than an IRA, or you make the rollover in 2014, attach a statement explaining what you did. For information on how to figure the taxable portion, see our distribution is taxable later. Rollover from employer's plan into an IRA. Can roll over into a traditional IRA all or part of your eligible rollover distribution you received from your or your deceased spouse's employed qualified pension, profit sharing, or stock bonus plan, annuity plan, tax sheltered annuity plan, which is a 503B plan, or governmental deferred compensation plan, section 457 plan. The qualified plan is one that meets the requirements of the Internal Revenue Code. Eligible rollover distribution. Generally, an eligible rollover distribution is any distribution of all or part of the balance sheet credit in a qualified Except the following. 1. The required minimum distribution explained later under what must you withdraw assets when must you withdraw assets? Required minimum distributions. 2. A hardship distribution. 3. Any of a series of substantially equal periodic distributions paid at least once a year over your lifetime or life expectancy, the lifetime of or life experiences of you and the beneficiary, or a period of 10 years or more. Corrective distributions of excess contributions are for and any income allocable to the excess or of excess annual additions and any allocable that was hard. 5. Loan treated as a distribution because it does not satisfy certain requirements either when made or later, such as upon default, unless the participants' accrued benefits are reduced or offset to pay the loan. 6. Dividends on employer securities. And 7. The cost of life insurance. Your rollover into a traditional IRA may include both amounts that would be taxable and amounts that would not be taxable if they were distributed to you and not rolled over. To the extent the distribution is rolled over into a traditional IRA, it is not includable in any non-taxable amounts that you roll over into your traditional IRA become part of your basic cost in your IRA. To recover your basis when you take distributions from your IRA, you should complete Form 8606 for the year of the distribution. See Form 8606 under Distributions Fully or Partly Taxable Later. Rollover by non-staff beneficiary. If you are a designated beneficiary other than a surviving spouse of a deceased employee, you can roll over all or part of an eligible rollover distribution from one of the types of plans listed above into a traditional IRA. You must make the rollover by a direct trustee to trustee transfer into an inherited IRA. You will determine when required minimum distributions in years after you make the rollover based on whether the employee died before his or her required beginning date for taking distributions from the plan. For more information, see Distributions After the Employee's Death and the Tax on Excess Accumulation in Publication 575. Written explanation to recipients. Before making an eligible rollover distribution, the administrator of a qualified retirement plan must provide you with a written explanation and must tell you about all of the following. You are right to have the distribution paid tax-free directly to a traditional IRA or another eligible retirement plan, or the requirement to withhold tax from distribution if it is not paid directly to the traditional IRA or another eligible retirement plan. 3. The tax retirement of any part of the distribution that you roll over to a traditional IRA or another eligible retirement plan within 60 days after you receive the distribution. 4. Other qualified retirement plan rules, if they apply, including those for lump sum distributions, alternate payees, and cash arrangements. And 5. How the plan receiving the distribution differs from the plan making the distribution and its restrictions and tax consequences. The plan administrator must provide you with this written explanation no earlier than 90 days, no later than 30 days before the distribution is made. The plan administrator must provide you with this. No, I just said that. But that is something that is a requirement of the bank that I want to test. However, you can choose to have the distribution made less than 30 days after the explanation is provided, as long as both the following requirements are met. A. You are given 30 days after the notice is provided to consider whether you want to elect direct rollover. Or B, you are given information that clearly states that you have this 30-day period to make the decision. Contact the plan administrator if you have any questions regarding this information. Voting requirement. Generally, if an eligible rollover distribution is paid directly to you, the payer must withhold 20% of it. This applies even if you plan to roll over the applicant distribution to a traditional IRA. You can avoid withholding by choosing the direct rollover option. Discuss later. Exception. The payer does not have to withhold from an eligible rollover distribution paid to you if either of the following conditions apply. A. The distribution of all previous eligible rollover distributions you received during your tax year from the same plan or at the payer's option from all your employer plans total less than $200. Or B. The distribution consists solely of employer securities plus cash of $200 or less in lieu of fractional shares. The amount withheld is part of the distribution. If you roll over less than the full amount of distribution, you may have to include in your income the amount you do not roll over. However, you can make up the amount within the funds from other sources. Withheld the funds from other sources. Other withholding rules. The 20% withholding requirement does not apply to distributions that are not eligible rollover distributions. However, other withholding rules apply to these distributions. The rules that apply depend on whether the distribution is a periodic distribution or non-periodic distribution. Either of these types of distributions, you can still choose not to have tax withheld. For more information, see publication 575. Withholding. No. Direct rollover option. Your employer's qualified plan must give you the option to have any part of the eligible rollover distribution paid directly to a traditional IRA. Plan is not required to give you this option if your eligible rollover distributions are expected to total less than $200 for the year. Withholding. If you choose the direct rollover option, no taxes withheld from any part of the designated distribution that is directly paid to the trustee of the traditional IRA. If any part is paid to you, the payer must withhold 20% of that part's taxable amount. Choosing an option, Table 1-5 next, may help you decide which distribution option to choose. Carefully compare the effects of each option. Oh, and we are there. Withholding additional tax or when the report is income is the affected item. And then you have, I guess, two options in two columns. One option being result of payment to you, the other being the result of the direct rollover. So, if you pick withholding as the affected item, the result of the payment to you is the payer must withhold 20% of the taxable part. The result of the direct rollover is there is no additional tax. If you are under the age of 59, probably and a half, a 10% additional tax may apply to the taxable part, including any amount equal to the tax withheld that is not rolled over. The result of direct rollover as opposed to, well, whatever, there is no 10% additional tax. The early distributions later as opposed to non distribution. When to report as income, as a result of the distribution, any taxable part, including the taxable part of any amount withheld, not rolled over is income to you in the year 2, or the benefit of a direct roll.